Last time, we took a look at AirSail Corp, ASLE, navigating the aviation aftermarket. Today we're shifting gears, climbing into a different cockpit, you could say. We're heading into the on-demand private aviation sector with Wheels Up Experience, Inc., ticker symbol UP. We've gathered a pretty hefty stack of recent financial data, news, valuation insights, all straight from our sources. Our mission, like always, is to cut through the noise, pull out the really important bits of knowledge, and give you a shortcut to understanding what's truly driving this, frankly, fascinating and often turbulent private aviation company.
Precisely. And Wheels Up, they operate a pretty unique model. They connect private flyers using a tech platform. It's a mix of owned planes, managed ones, and third-party aircraft, offering both memberships, sort of programmatic flying, and on-demand charters. It's all one operating segment, really, with most of the revenue coming from right here in the U.S. So today, we'll dig into their financial health, their market performance, and some of the recent strategic moves that are really shaping their flight path right now.
Okay, let's unpack this with some hard numbers then, because, our sources paint quite a picture of volatility, don't they? As of September 5th, Wheels Up closed at just $2 a share, and that involved a pretty steep 19.35% drop on that single day alone. But, one day is just one day, right? What do the broader trends tell us?
Well, what's really striking here is the sheer amplitude of the swings. I mean, yes, that daily decline was significant, but if you zoom out a bit, looking at performance across different periods reveals a stock that's been on a genuine roller coaster. We see a sharp minus 39.39% performance over the last week alone, yet somehow it managed to be up 45.99% over the last month and 41.84% over the last quarter. Even looking back a full year, it's actually shown a 16.28% gain. However, and this is really the critical context, its 3-year performance stands at a stark minus 89.36%. This isn't just, typical market fluctuation. It strongly suggests a company going through some profound changes, with the market reacting, dramatically to every single update.
That's quite the ride. And this kind of extreme volatility, it isn't just random noise. It feels like the market grappling with the whole Wheels Up story. A story of, deep struggles on one hand and some really aggressive attempts at reinvention on the other. So to really get this narrative, let's zoom out. Look at the company's actual financial footprint. What's its market size? And how are the core financials looking underneath all that stock movement?
Right. So Wheels Up currently has a market cap of about $1.40 billion, and its enterprise value is $1.76 billion. Now, for listeners maybe less familiar, enterprise value, it adds things like debt to the market cap and subtracts cash. So it gives you a more complete picture of the company's total value, reflecting, both equity and debt financing. Now, when we pivot to profitability, the numbers indicate ongoing and pretty significant challenges. The company reported a net income of minus $326.88 million, and an EPS, that's earnings per share, for the trailing 12 months, the EPS TTM of minus 0 to 47 cents. Their profit margin is negative 42.68%, operating margin a negative 31.37%, and even their gross margin is razor thin at just 4.93%.
Wow, those are some very deep red numbers. Definitely indicates a company burning through cash. And when a company isn't profitable like this, we often look at how efficiently they're using their existing resources, right? So how do their efficiency ratios look? Things like return on assets or return on equity.
Yeah, this raises a really important question about capital efficiency. And here the figures become, even more alarming. We see a return on assets, ROA, of minus 31.25%, a return on equity, ROE, of negative 2,416.94%, and return on invested capital, ROIC, of minus 346.43%. These aren't just bad numbers. An ROE like that, minus 2,400%, it signals the company is fundamentally upside down. It likely means they have negative equity. So Wheels Up isn't just losing money, it's actively destroying shareholder value at an astronomical rate. It makes any path back to sustained profitability a truly monumental uphill battle. They essentially have to rebuild from a significant deficit.
Wow, okay, that really puts the operational and financial challenges into stark perspective.
Yeah.
Given those figures, what do our sources say about their revenue trends? Is the top line still growing at least?
They reported sales of $765.88 million. However, sales growth itself has been facing some pretty significant headwinds. Sales year over year, again looking at the trailing 12 months, were down 20.21%, and sales quarter over quarter were down 3.39%. So the top line revenue is contracting, but And this is a crucial nuance. I think the EPS, the earnings per share for the trailing 12 months, despite still being negative, it has actually improved by 88.09% year over year and 15.32% quarter over quarter. So what that tells us is they might be making some strides in cost control, maybe operational efficiency, effectively slowing the rate of losses, even while their overall revenue base is shrinking.
So a mixed bag then. Continued struggle on profitability, but maybe some green shoots in terms of managing those losses better. That's a fascinating distinction, improving the rate of loss even while sales decline. Suggests some hard work internally. Now let's pivot a bit. Who actually owns Wheels Up and how liquid is the company? Because our sources flag something particularly interesting here. We see a significant portion owned by insiders, right? 39.07%. And institutional ownership is also high, 48.61%. However, both groups show recent net selling activity. Insider transactions at minus 0.09% and institutional transactions down a hefty minus 15.92%.
Indeed. And, high insider ownership often suggests confidence, right?
Yeah.
Alignment with shareholders. But when you combine that high ownership with these negative transaction figures, meaning insiders have actually been selling shares, it raises a very pointed question. Our sources detail specific sales from key individuals: David Holtz, Donald Moak, Brian Kedzior, David Godsman, Mark Briffa, Alexander Chetkowitz. These sales happened as recently as August 2025, stretching back into 2024 as well. These aren't just, minor divestments. While some selling is always routine for liquidity reasons, such consistent activity from multiple executives during a period of such financial turmoil and this attempted turnaround, it's a quiet, but I think potent signal. It suggests that maybe even those closest to the operations might be hedging their bets a bit, which raises a critical question about internal confidence, doesn't it?
That's a really crucial detail for investors to weigh.
Okay,
moving on to the company's immediate financial health. How liquid is Wheels Up right now? Can they pay their bills?
On the liquidity front, Wheels Up has a quick ratio of 0.24 and a current ratio of 0.25. Now, for our listeners, a quick ratio typically below 1.0 suggests the company might struggle significantly to meet its short-term obligations using its most liquid assets, like cash or receivables. These numbers, 0.24 and 0.25, are extremely low. It indicates very tight financial breathing room and, a potential challenge in covering immediate bills.
Okay, so tight on cash. Insiders selling recently, despite high overall ownership. What about the outside view, specifically from financial analysts? Are they seeing the same somewhat grim picture?
Well, surprisingly, perhaps, analysts on average give Wheels Up a recom that's short for recommendation rating of 1.67. On a standard scale where 1 is a strong buy and 5 is a sell, 1.67 generally falls into the buy or even strong buy range. And what's particularly striking, maybe even jarring, is the average target price, $32 compared to the current $2 share price. It's a huge gap. It implies analysts see massive upside potential despite the current financial picture we just discussed. Now, we've seen various ratings over time, from buy and outperform at places like Goldman and Credit Suisse to underweight from Morgan Stanley. But that consolidated $32 target suggests a strong belief in a substantial future recovery or maybe some kind of revaluation. Perhaps they're banking heavily on the success of these turnaround efforts.
A $32 target versus a $2 stock price. That's quite a spread. It seems analysts are either incredibly optimistic or expecting some kind of, monumental shift. Let's explore the actual events and announcements then. What might explain both the volatility we've seen and this analyst optimism? What strategic developments have been shaping Wheels Up recently?
Well, what's really striking here is a consistent pattern of intense activity, especially around operational streamlining and financial stabilization. Just in the past few months, for example. September 3rd, they launched a new membership portfolio. August 31st, news of $1 million cost savings expectations. August 27th, they announced the sale of 3 non-core units, which was elaborated on August 20th as a divestiture of non-core services businesses. This isn't just, shuffling deck chairs. It feels like a laser focus on cutting inefficiencies and really sharpening their core offering. It seems like a direct response to those profitability challenges we talked about.
Okay, so they're clearly cutting the fat, trying to refine the business model. What other moves have they made on the operational side to maybe support this turnaround effort?
Absolutely. Beyond just the immediate streamlining, they've been quite busy shaping their future operations. Back in June, they announced executive leadership changes, aiming to better align their go-to-market strategy, accelerate growth. Earlier in May, they launched a new sustainable aviation fuel program, SAFE, which signals, a forward-looking environmental commitment. And looking back a bit further, into late 2024, there were some significant capital moves. November saw Wheels Up secure a $332 million revolving financing facility, and they completed the acquisition of 17 Phenom 300 series aircraft, which was part of a broader fleet modernization strategy announced back in October 2024. They also streamlined their product portfolio in June 2024 and opened a new state-of-the-art maintenance facility down at Palm Beach International Airport in April 2024. These are all pretty significant operational and capital allocation moves. It demonstrates a really serious push for strategic and structural change, I think.
That sounds like a comprehensive overhaul, like a company completely rebuilding its foundation, almost from the ground up. And speaking of foundations, our sources also highlighted a bit of a bumpy road with the NYSE listing standards. What's the story there? How does that relate to their financial stability?
Right. This brings us to a critical timeline that really underscores the urgency of these strategic shifts. In June 2025, Wheels Up actually regained compliance with the NYSE continued listing standard, which is definitely positive news. However, and this is vital context, it's important to note they had received an NYSE continued listing standard notice just 2 months prior in April 2025. And they got another notice a year before that, back in April 2023. These notices often signal concerns about the share price falling below minimum thresholds or market capitalization dropping too low. So their history of being, on and off the NYSE's radar really highlights a precarious balance and the intense pressure that must be driving these turnaround efforts.
So they've been fighting just to keep their spot on the exchange. That certainly adds another layer of pressure. And to shore up that foundation, our sources also highlighted some massive, almost rescue investments that were absolutely pivotal, weren't they?
Precisely. A key development, one that truly reshaped the company's trajectory, I'd argue, was back in September 2023. That's when Wheels Up finalized a new investment partnership with Delta Airlines, Certarus, Knighthead, and Cox. This followed news from August 2023 that the company had landed a crucial $500 million rescue package. That package effectively put Delta and these other investors, in control. It was a really pivotal moment coming after a period in June 2023 when the stock just plunged 60%. And the company announced a reverse stock split, a move often used by companies specifically to boost a share price to meet listing requirements and avoid being delisted.
Right.
So that rescue package and the reverse split really highlight the turbulence and, frankly, the existential threats they've navigated. It's the kind of dramatic move you see when a company is quite literally fighting for its life, a high-stakes gamble for everyone involved.
Okay. We've seen a lot of data points then. Extreme stock volatility, deep losses, but also these aggressive strategic realignments and those significant, even dramatic investments. How do we pull all of this together? How do we try to understand the underlying value of a company like Wheels Up, especially with so many moving parts and such a, fraught history?
Yeah, this is where valuation models usually come in, things like discounted cash flow, DCF. But there's an extremely important caveat here. For Wheels Up specifically, a standard DCF valuation tool from one of our key sources includes a very prominent warning. It states, and I'm quoting here, business predictability result may not be accurate due to the low predictability of business. That's a crucial, almost flashing red light for anyone attempting to value this company using traditional methods.
Low predictability. That's quite a warning, isn't it? What does that mean practically for how we approach something like a DCF model, which is usually a go-to tool for valuation?
It means that while a DCF model is a powerful tool, right, it estimates intrinsic value by projecting future earnings or cash flows and discounting them back to today. Its reliability hinges heavily on consistent historical performance and the ability to reasonably forecast the future. Without that predictability, the assumptions you have to make about future growth rates become much, much more speculative. It turns an analytical exercise into something, closer to a guessing game. Typically, a DCF model uses 2 stages, a growth stage, then a terminal stage, with various parameters for growth and discount rates.
Can you quickly walk us through those core components that make up a DCF, and maybe where Wheels Up specifically might run into trouble with them?
Certainly. The core components start with current earnings, usually adjusted to exclude any one-off, non-recurring items to get a baseline. Then there's the discount rate, which is absolutely crucial. It's essentially the expected rate of return an investor demands. It accounts for a risk-free rate, like a government bond yield, plus an equity risk premium to compensate for the added volatility and risk of owning that specific stock. This usually lands somewhere between, say, 6% and 20%, reflecting the company's risk profile. Higher risk, higher discount rate. Then you project a growth rate for an initial stage, often based somewhat on history, but capped usually between 5% and 20% to prevent overly optimistic forecasts. And finally, there's a terminal growth rate for the long term, typically set around the expected long-term inflation rate, maybe 4% or so. Critically, this must be lower than the discount rate for the math to actually work. The model also often considers tangible book value, that's a company's assets minus liabilities, but excluding intangible assets like goodwill. And as we noted, with Wheels Up's book value per share being negative, that further complicates any traditional asset-based valuation approach, really reinforcing that low predictability warning. The inherent low predictability of the business, explicitly noted by valuation tools, suggests that making reliable long-term financial projections here is particularly challenging, perhaps even futile for now, and that recent insider selling, despite the high overall insider ownership, just adds another complex layer for investors to consider, doesn't it?
It really does. It paints a picture of a company in extreme flux, striving for a turnaround in a very competitive, very capital-intensive industry, all while under intense scrutiny from the market and the stock exchange itself.